What if your money could keep paying you even while you sleep? Not by working more hours, not by trading every day, but simply by owning the right investments. That's the idea behind dividend investing, and in this video, I'm going to break it down step by step, starting with what passive income really is, why dividends matter for building wealth, and how dividend stocks differ from growth stocks. If you're new to investing, this is the foundation you need to understand before putting your first dollar to work. Let's start with the concept of passive income. Passive income is money you earn without actively trading time for it. Unlike a job, where you're paid only when you work, passive income continues to flow even when you're focused on other things. This is why it's so appealing to new investors. It creates flexibility, scalability, and long-term financial leverage. One of the most common ways to generate passive income is through dividend investing. When you invest in dividend-paying companies, you're buying shares in businesses that regularly distribute a portion of their profits back to shareholders. These payments, called dividends, can arrive quarterly, monthly, or annually, depending on the company. And there's a double benefit here. First, you receive ongoing income. Second, your shares can increase in value over time, meaning you benefit from both income and growth. For beginners, the key is focusing on companies with a strong history of paying and ideally growing their dividends. Consistency matters far more than chasing the highest yield. Another crucial principle is diversification. By spreading your investments across different companies and industries, you reduce the risk of any single investment hurting your overall income. If one company underperforms, others can help stabilize your returns. And finally, it's important to understand that dividends can be taxed differently depending on where you live and which accounts you use. Some investment accounts offer tax advantages that can significantly improve your long-term results, so this is an area worth learning or getting professional guidance on. Passive income through dividends isn't about speed. It's about building something reliable over time. Now let's talk about why dividends are so powerful for building wealth. Unlike capital gains, which only matter when you sell, dividends give you a real, tangible return while you still own the asset. That alone makes them valuable. But where dividends truly shine is through reinvestment. When you reinvest your dividends, they buy more shares. Those shares then generate more dividends. And over time, this creates a compounding effect that can dramatically accelerate your portfolio's growth. This is how long-term investors turn relatively modest investments into substantial wealth without constantly adding new money. Dividends also add a layer of stability. Companies that consistently pay dividends tend to be established, financially sound businesses. Their commitment to returning value to shareholders often signals discipline and long-term sustainability. For new investors, this reliability can make market volatility easier to handle. Even when stock prices fluctuate, dividend payments can continue arriving, providing income during periods when growth is uncertain. In fact, during market downturns, dividends can act as a buffer. While prices may drop, income can remain steady, helping investors stay invested instead of reacting emotionally. In short, dividends don't just grow wealth. They help investors stay consistent, patient, and focused on the long term. To invest effectively, it's important to understand the difference between growth stocks and dividend stocks. Growth stocks are shares in companies expected to grow faster than the overall market. These companies usually reinvest their profits back into expansion, new products, new markets, or innovation. Investors buy growth stocks primarily for price appreciation, hoping to sell them later at a higher value. Dividend stocks work differently. Dividend-paying companies return a portion of their profits directly to shareholders. The goal here isn't rapid expansion, it's consistent performance and regular income. Because of this, dividend stocks are often more stable and less volatile than growth stocks. Their appeal lies in reliability rather than speed. The difference ultimately comes down to investment goals. Growth investors focus on future value. Dividend investors focus on ongoing income. Growth stocks can offer higher upside, but they often come with higher volatility. Dividend stocks typically offer lower growth potential, but greater predictability. For many investors, especially beginners, the most effective strategy is not choosing one or the other, but understanding how each fits into a broader plan. What matters most is aligning your investments with your time horizon, risk tolerance, and income needs. Dividend investing is not a shortcut to wealth. It's a system built on patience, consistency, and long-term thinking. By understanding passive income, the role dividends play in wealth building, and how dividend stocks differ from growth stocks, you give yourself a strong foundation to make smarter investment decisions. In the next video, we'll go deeper into how dividends actually work and what to look for when evaluating dividend-paying companies. Thanks for watching.